Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend and a great start to your week. Going to jump right into the questions here. First from DM. Luke, the West always seems to win despite having the odds stacked against them. It seems that individualism and freedom are the most important factors in a nation's success. Is there any scenario where you see the U.S. keeping U.S. dollar reserve status for the next, say, 5 decades? That's really my base case. I think the U.S. is going to keep global reserve currency status. I think winning for the U.S. is keeping global reserve currency status for the dollar while ending the U.S. Treasury bonds primary reserve asset status and basically ditching that for a neutral reserve asset like gold or even Bitcoin that floats in all currencies. If we don't do that, if we don't get rid of the Treasury bond as primary global reserve asset, then we will lose. And the reason that is you will see what we have seen over the last 40 years continue, which is a complete increasing deindustrialization of the U.S. defense supply chain, a continued hollowing out of the U.S. middle and working classes, leading to increased political instability in the United States, increased bifurcation of wealth, and sort of all of the negative impacts around that. And so it really is a matter of national security to basically evolve the system back to the future and fix what was wrong with it before, which is to say dollar remains global reserve currency status, neutral reserve asset like gold or a Bitcoin, but that neutral reserve asset can't be pegged to the dollar. It has to float in all currencies. And so I think that's where the system is evolving to, and we'll see if it keeps evolving in that direction. From RD. In the 1950s U.S. or 1980s Israel-style inflationary scenario, like you discussed, would Medicare reimbursements and Social Security payments get debased to meaninglessness or raised greatly and offset by more money printing or somewhere in the middle? I think it's somewhere in the middle. I think last year is probably a pretty good example, or this year, excuse me. We had a 5.9% cost of living adjustment for Social Security with 8 CPI. I think that's ultimately the goal. I mean, we saw from 1946 to 1980, we saw nominal GDP consistently run 500 to 800 basis points above the interest rate on long-dated U.S. Treasuries. So it's just a long, more aggressive financial repression, effectively. From David, we don't know the strike price of the J. Powell pivot, but what are the chances there is none and he lets the free market go? I think the chances that Powell lets the free market go are very low, bordering on 0%. The reason I say that is if he allows that, then what we will see is stocks down, yields up. We will see yields up because with stocks down, we will see consumer spending down, we will see GDP down, we will see tax receipts down, which means we will see Treasury issuance up as we will see the dollar up, which we will see global selling of Treasuries alongside Treasury, alongside the Fed. We will be in a doom loop spiral of interest rates up, asset prices down, until either asset prices hit zero and the system collapses, or the U.S. government defaults on Treasuries, or until Jay Powell steps in. And so that's really, I don't think systemic collapse is what he is willing to allow on his watch, and so we're all just sort of sitting around waiting to see where that is. To be clear, I think the Fed is going to have to relent on tightening by the end of 3Q22, which is far earlier than consensus. From QR, will markets break the economy or will the economy break markets? Markets effectively are the economy. We've talked about consumer spending's 2/3 of GDP. Net capital gains plus taxable IRA distributions alone are 200% of annual growth in U.S. consumer spending. So if stocks aren't rising, consumer spending's going to have a hard time rising. So it's a feedback loop. Dollar too high, rates too high are going to trigger that doom loop feedback loop that we've been seeing over the last really month and even much of the year to date. From J.E. Hi, Luke. Your weekly writings are always top-notch. Thank you very much. In a recent Tree Rings, you mentioned that you've heard rumblings about new energy technologies, even though it's far from reality. What technologies are on your radar? I think it's any type of revolutionary technology is really energy technology, in specific, is a way out of the predicament in which we find ourselves. Basically, a way of really improving the productivity of the U.S. and global economy. I've heard rumblings of small, almost portable by truck pebble bed nuclear reactor type stuff. Hear rumblings that technology like that might exist or be under development. Anytime I read anything about nuclear fusion, it gets my interest, although take it with a block of salt because I'm not a scientist, so it still seems pretty far off. But those types of things, when you hear rumblings about them or see them, that I think those are things that could be real game changers that I watch for that would force a real revisit of my worldview. From RJ, some commentary on the price action in gold would be interesting. It's selling off a bit in a sharp market sell-off, which is not, it's not atypical. It's pretty typical. Quite frankly, it's not been as much as I would have maybe feared thus far. I mean, we saw this in 2008. Gold hit $1,000 an ounce in February of '08. Was 700 by December. 2020, it sold off sharply as well in a much more compressed time frame. So ultimately, I would expect gold at new highs whenever the Fed is forced to relent on tightening, which, as I said before, continue to think is probably by the end of 3Q22. Would be my current estimate. From Tim, do you think the Russian oil for gold trade is more or less likely than when originally floated out there as an idea? I think it's getting more likely because the West is getting more aggressive. It seems like the situation is getting more hostile, the West getting more draconian with some of the proposed energy sanctions on Russia. And so I think it strains credulity to think Russia would just stand aside and not respond financially. And this is one way that they could. From Justin, curious to get your thoughts on the possibility of the 1980s Soros, Druckenmiller strong dollar playbook being run, where the Fed tightens policy, strengthens the dollar, sort of brings the world to its knees, to paraphrase. And it raises, Justin, I think, raises a really interesting point that if the U.S. can strengthen the dollar enough that it breaks up the Eurozone and basically frees Germany again to be its own standalone surplus nation that could then recycle surpluses into treasuries, might that be a way to buy the U.S. time? In theory, yes. The challenge, I think, is just the mismatch between the deficits we need to finance and the size of the German surpluses are massive. There would still need to be a lot more. We're still very short foreign creditors if that happens. I think it also is a long shot simply because it would be a bet that basically the EU would break up in a non-chaotic manner. It would break up quickly and soon, which is what the U.S. needs in terms of increasing foreign financiers for treasury bonds. And then it also assumes that in that scenario, Germany would immediately buy treasuries. And I think most critically, it assumes that the United States is not negatively impacted economically by rising rates and falling asset prices. And I just think that rising rates and falling asset prices are likely going to hit the brakes on the U.S. economy far faster than any potential breakup of the Eurozone, etc. So continue to think that the Soros-Druckenmiller playbook, where the Fed squeezes the dollar higher, as there are, as we wrote about last week, Washington insiders are saying that that's the plan. I think it's going to be, they tried it in 2018, it failed miserably. They're trying it again. I think it's going to fail even more miserably, even faster this time. From TS, in your view, gold needs to be pegged to energy at a fixed rate, or its price should be left free to fluctuate against all other assets, aka free gold, without the influence of paper derivatives? I think the system is fixing a weight of gold to a unit of energy. So 50 barrels per ounce of gold, for example, 100 barrels per ounce of gold. Then the price of both of those float. Every nation is free to make policy decisions about what works best for their country. Countries that have a lot of oil can have cheap oil and cheap gold, and they're going to have a strong currency. Those that can produce a lot of oil at a high price can have expensive oil. But they're going to have expensive gold, and through the gold link, they're going to have a weak currency. And so that gets rid of mercantilist nations like China, Germany, Japan, and it gets rid of mercantilist policies of nations like China in particular, but Germany and Japan as well. And it also gets rid of the U.S. exorbitant privilege of having expensive oil and cheap gold, artificially overvaluing the dollar and hollowing out our manufacturing sector, hurting working and middle class jobs. So with that, I'm going to finish up for the night. I want to thank everybody for joining me. As always, if you want to see what we're up to, check out FFTT-LLC.com. Also can check out Tree Rings, our weekly 10 most interesting things product, quick synopsis of each of those 10 things and what grabbed our attention about it, whether it supports something, a way of thinking that we've been looking at things, or a lot of times things that surprise us and refute and make us change our minds or think differently about something we had been thinking. So get a lot of great feedback on it. Check it out. In the meantime, everybody, have a great rest of your week. Look forward to talking with you soon. Take care, everybody.